What if I told you you could operate your business exactly how you do, change nothing except for how you file taxes, and you could save 29% on your tax bill, thousands of dollars every single year? Well, buckle in because I'm going to show you exactly how to do just that by paying yourself as an LLC. And on top of that, we're going to cover the difference between a regular LLC and an S Corp. And I believe that this is important information for any business owner to understand. And by the end of this video, you should be able to just bust into your accountant's office with confidence. So to start this off, let's start off with a regular LLC. First off, an LLC is a legal structure for your business that separates you from potential liabilities of the business. A single member LLC is considered a disregarded entity because it is not separate from the owner for tax purposes. On your tax return with a single member LLC, you and that LLC are the exact same thing. And this is an important thing to remember. Let me just reiterate. A regular old LLC does not change your taxes. It only changes your liability. A single member LLC is the exact same thing as a sole proprietorship on your taxes. Now, the difference between a sole prop and an LLC is you generally are not personally liable for first debts held by your LLC. That's why when you first start out a business, it's really hard to get a loan on the business without personally guaranteeing it. And second, you're generally not personally liable if someone sues your LLC. Or I suppose I should say when someone sues your LLC, because hey, this is America, and if you're in business long enough, you will get sued for some absolute nonsense. I know I have multiple times. Anyways, with a sole prop, you are always personally liable. With an LLC, not always. So you're probably wondering, if an LLC doesn't change your taxes, how do you save taxes with an LLC? And this, my friend, is with an S Corp. An S Corp creates a legal tax loophole that actually benefits the middle class.
Hey, that's pretty good.
It's very rare. The largest beneficiaries of this are people who make between $40,000 and about $200,000 a year. So let's first cover how taxes work for a regular LLC, and then we'll cover how they work for an S Corp and how you can potentially save thousands of dollars every single year. Millions of businesses use this. It is an extremely helpful way to file your taxes. So to explain this, imagine you have a bakery business, Hot Buns & Co. Hot Buns & Co. is an LLC that you own 100% of. Let's say your Hot Buns made $300,000 in sales last year. And this is already starting to sound like a totally different kind of business, but we're gonna try to keep our heads out of the gutters here for the sake of this example. So you have $300,000 in sales and you have $250,000 in expenses, to help pay for the building, help butter your buns, and help market your buns. So this leaves you with $50,000 in dough left over. Get it? Dough left over. I don't know. Anyways, now you need to pay yourself that $50,000. But when you're a single member LLC, this is not called payroll. This is called a disbursement. So you pay yourself the disbursement, and then you need to pay taxes on that $50,000 disbursement. Now we can see here that of our $50,000, the biggest chunk, the biggest expense gets paid towards payroll taxes, Social Security and Medicare. These two things total 15.3% of all your earnings. And then we do get some deductions, which you can see on this chart, and then we're left with a charge for $5,726 in Social Security and $1,339 in Medicare. And then we have our regular old federal taxes, and in this case, we're in the 22% tax bracket, and the state I use is Arizona, which is about the medium range for state taxes. So this one will vary a little bit depending on your state and what your state taxes are. And then we look at what we actually get to keep. After a year of busting our buns at the bakery, we get to keep 77.8% of our profit and take home about $39,000. Now, this isn't to say a regular LLC is a bad idea. It's actually a pretty good choice for many people, especially if you just started a business and it doesn't have a ton of profit yet, or you just simply want protection from liabilities. You want protection from that nonsense lawsuit that everyone comes across at some point in business. Now, it does vary a little bit state to state on how to actually get your LLC, but you can generally do so through your state's website. Or if you don't want to dig through your state's website, I've linked a service in the description called IncFile that will help guide you through that whole process just for a small fee. And they can actually help you set up either a regular LLC or an S Corp if you want some help with the process. It's also always a good idea to ask a tax professional if that's the right move for you, because I am not a financial advisor or a CPA. I'm just a dork who likes to talk about tax every once in a while. Now let's talk S Corp and how you in Hot Buns can save some money on your taxes, save some hard-earned dough. So you talk to your accountant and you decided an S Corp is for you. To make the transfer, you need to file 2 documents. You need to first file Form 2553, which is an election by a small business corporation. And then second, you need to file a Form 8832, which is your entity classification. Now, an accountant can do this for you, or that IncFile service I mentioned can do this for you, whatever you want to go with. Now, back to your Hot Buns. So we still have $300,000 in sales, we still have $250,000 in expenses, and we still have $50,000 in dough left over. Now, this is where things get a little bit complicated, so I need you to hang in there with me if you're trying to save some bread. I can't help myself with these puns. So this time, instead of paying yourself a disbursement, you're actually paying yourself as an employee on payroll. But here's the kicker. You don't have to pay yourself all of your business's profit as payroll. And if we remember, we go back to our first example with the regular LLC, our biggest expense was payroll taxes. So with an S Corp, you only need to pay yourself what's called a reasonable wage. And how much is a reasonable wage, you ask? Here's the funny part. No one knows. The IRS doesn't even know. There is no set rate for a reasonable wage, and this is because a reasonable wage is based on the activity that you're performing and how much profit is made from the business. So you can kind of think of this like if you were to hire someone to replace your position, how much would you have to pay to hire them? That'd be one way to think of what your reasonable wage would be. Now, most of the time, accountants recommend a percentage of your profit as a reasonable wage. I have heard this recommended anywhere between 30% of your profit to 60% of your profit to be paid as a reasonable wage. The lower percentage you choose, the more money you're going to save, but this also is higher risk of upsetting the almighty IRS. So for the sake of this example, I'm going to go with the middle ground of 45% of profits. 45% of $50,000 is $22,500. Now this is where you start saving some cash. Remember how we paid payroll taxes on the full $50,000 with a regular LLC? Now we only have to do that on $22,500. So we pay the 15.3% for Social Security and Medicare, add back the adjustments, and we're left with $2,577 in Social Security tax and $603 in Medicare, $3,885 in savings. But that's not quite the whole story. We can see on this chart that there are some other small changes we need to talk about. Our federal and state income tax is a tiny bit higher with the S Corp. This is because calculations are slightly different with what's called a QBI, the Qualified Business Income Deduction. Now, a QBI is a little bit too technical to really break down in this video, but basically it allows for 20% of your distribution income to be deducted from your taxable income. So it affects the total tax that you end up paying. Beyond this, we can also see that there are small payments for federal and state unemployment to your S Corp that we didn't have with the regular LLC. Now the state portion can vary. In most states it's pretty low, but in Hawaii and Minnesota it's actually quite high. And then one final item that you want to consider is the franchise tax on your business that is only on S Corps. It's not on regular LLCs. Most states have a low or no franchise tax at all, but Tennessee, New Jersey, New Hampshire, and Louisiana have high franchise taxes. So in those states, it doesn't make as much sense for an S Corp. That's when you really want to do some digging if you have to be in one of those states. Now, zooming out to full savings, we can see that in this scenario, the S Corp shows dramatic savings of $3,247 on $50,000 in income by doing nothing but changing your tax filing status. That's a 29% reduction in tax. And if we had $100,000 in income, that $3,200 would bump up by about 80%. This scales up pretty dramatically. So if this video taught you anything new or will save you some cash, all I ask in return is to hit that like button, hit that subscribe button, and maybe even share this with a business owner, friend, a cousin, a stranger at the bus stop, whoever you want to share this with, go ahead and share it. So I'd like to thank you for watching, and I hope you have a profitable day.